Hello, everyone, and welcome to this presentation. I'm Dr. Naser Makarem from the University of Aberdeen, and today I'm presenting a paper called Earnings Manipulation by Zombie Firms. So, at the beginning, just an introduction about zombie firms, how we define them, and what is their impact. Zombie firms are firms that barely actually operate. They exist just because of the support they receive from external supporters. They don't make much profit, and they're not able to pay their interest because of the issues that they face in their activities. And they're normally linked with lower productivity, lower profitability, and they're unable to service their debt. Um, After the financial crisis of 2008, what happens was that there were some policies aimed at helping companies. But what happened was that it actually helped those unproductive firms to actually survive. And they actually unintended impact of those supportive policies was that we saw uh, uh, higher zombie firms after the financial crisis. And if you look at prior studies, you see that zombie firms are linked to lower interest rates and as I mentioned, these policies, the supportive policies after the financial crisis have actually increased the number of zombie firms. So what is the importance of zombie firms? Uh, they are very important. Why? Because they result in bad resource allocations. So basically, the resources that could be otherwise used more productively by better firms investing in better projects are locked up by these zombie firms. So the survival of these zombie firms creates a lot of inefficiencies in the market and a lot of resource misallocation. So these are very important firms to actually to investigate. So what are we going to do in this study is that we're going to have a look at zombie firms and we're going to see whether these firms are engaged in earnings management. So earnings management, as most of you may be aware, are techniques that are used by companies to actually change their bottom line, their earnings. It could be that most of times these are income increasing because firms they want to actually show a better picture about their performance, but there are some instances that firms may want to actually reduce their earnings as well. For example, for avoiding political costs. So basically, we're looking at zombie firms uh, to see their earnings manipulation behavior. And it is very important. Why? Because by looking at their earnings management strategies, we can see how they can actually survive. So these earnings management strategies are used by zombie firms to actually extend their life. Yeah, this is our assumptions, or our hypothesis that we predict that zombie firms engage in earnings management to actually live longer. So, in terms of data, we took data from Compustat. We got data from for the period 1991 till 2021. And as you can see, in the process of sample selection, we actually reduced the sample. We excluded financial and regulated industries. This is the norm in earnings management studies. We also had some missing data because running the regressions for calculating earnings management requires some data availability. For example, we grouped firm years by year and industry. So if there is not enough observations in each in firm year, in each industry year, then we have to remove those the whole batch. So that's one reason for missing data, and also, of course, in every data set, there are some missing data that needs to be removed from the sample. So we also after applying all those restrictions, the final sample includes around 50,000 firm-year observations. So you also see a breakdown of zombies and non-zombies based on their sector here as well. So out of around 50,000 observations, around 1,600 are recognized as zombies, and I will explain how we measure zombies. So this is the basic model that we use. The idea is very simple. We got earnings management as the dependent variable, and we got the main variable, which is zombie firm, and some control variables. So we measure earnings management using accruals-based measures, mainly modified Jones model, Dicho et al. 1995. We also measure real activities manipulation or real earnings management. They're both used, or they are used interchangeably. So we use the three measures introduced by Roy Chaudhary 2006. So we look at abnormal cash flow from operations, abnormal discretionary expenses, and abnormal production costs. We also use the aggregate measure of real activities manipulation suggested by Zhang 2012. To identify whether a firm is a zombie or not, we follow Acharya et al. 2020, and the firm is classified as a zombie if it meets two criteria. If it has an interest coverage ratio below the industry median, and a leverage ratio above the industry year median. And if it secures credit at exceptionally low rates. And we actually operationalize this one by looking at AAA rated borrowers to see whether they got a lower rate than them or not. And we look at firms with similar debt structure to find out whether they get a lower interest rate or not. We also have a number of control variables which are firm specific, including the ones measuring performance, growth, size, leverage, a long list of control variables based on prior studies. So this is the basic results that we have. As you can see, we got abnormal cash flow from operations, abnormal production costs, abnormal discretionary expenses, and the aggregate measure of real activities manipulation, and also discretionary accruals. And you see the coefficient on zombie. You see the coefficient is positive and significant for abnormal cash flow operation for abnormal cash flow from operations. It is also positive and significant for abnormal production costs. Uh, Also negative and significant for discretionary expenses. All of these show income increasing real activities manipulation by zombie firms. It is also in line with the aggregate measure, so you can see a positive and significant coefficient on real the aggregate measure of real activities manipulation, the fourth column. And finally, fifth column, you see the coefficient related to discretionary accruals, and it is also positive and very significant. So all these measures of earnings management show income increasing earnings management by zombie firms. And as you can see, we got firm fixed effects, we got control variables, we got year fixed effects included in our model as well. So basically, our results indicate that zombie firms are engaged in both in income increasing earnings management in terms of both accruals management and real activities manipulation. So these results are in line with prior studies like Healy and Wallen 1999, Benish 1999, Graham et al. 2005, and they suggest that financially distressed firms are more likely to engage in earnings management, which is in line with what we found. We also our results also consistent with Zhang 2012 and Cohen and Zarwin 2010, and as they show that distressed firms like zombie firms are engaged in real activities manipulation to meet earnings targets and attract capital. Um, uh, I need to emphasize that distressed firms are different from zombie firms. So zombie firms have just survive because of the external support that they have, and as I mentioned, they have a specific definition. So they're kind of they're kind of a sub a set of distress firms, a special kind of distress firms, if you like. So what are the main takeaways from our study? We show that zombie firms engage in both real activities manipulation and accruals management, and they do so because they want to hide their financial difficulty, and they also want to maintain external financing support. So they want to show that they're able to survive. They're making perhaps improvement in terms of their profitability, but they're using earnings management strategies to actually show better performance than they're actually doing. So they're basically window dressing their accounts to actually make the impression that they're improving their in terms of their profitability, while in reality they are not. Um, we also we showed that they are engaged in real activities manipulation, and that shows that these companies are actually distorting their operations in order to provide a better picture about their performance. Um, what are the consequences of zombie firms engaging in earnings management? These manipulating activities actually, of course, they distort financial the reporting of firms. They decrease the level of transparency in the market, and as a result, they end up with misallocated uh, um, resources in the market. So that's what will affect the overall financial stability of the market as well. So it has very extensive implications for the market, the existence of zombie firms. So what is the implication of our study? Our results indicate that zombie firms they actually resort to value destroying measures like real activities manipulation, and also activities that reduce the transparency in the market, like accruals management. So that means that we need a stronger regulatory oversight to actually prevent these activities, and also as a result, we will have less inefficiency and less misallocated resources in the market. So what we have done was to look at public companies, but it would be interesting to actually for future studies to look at private firms as well, to see whether they behave the same way as public companies. We also It would also be worthwhile to actually investigate long-term economic consequences of zombie firms engaging in earnings management, to see whether what happens next. So at some point in the future, when they keep on manipulating their accounts, at some point they can't do anything more. So it would be interesting to see the long-term impact of their earnings management strategies. Okay, so that brings us to the end of this presentation. It was just to introduce the topic, but we will have more on this, including robustness checks and more on the literature. But the time for this speech was limited. So thank you so much for your attention.